Good afternoon, ladies and gentlemen. Good afternoon, and welcome to the ActivTrades Monday Market Matters webinar for the 23rd of October. And today we're here to talk about how to trade range-bound markets. Before we start, just to ensure that the technology is on our side, I hope that you can all hear me, and I hope that you can see the slides. If you could let me know, some of you here in the room in the chat box would really appreciate it, just that you can see and hear us. So we're starting off on the right foot. Today, we are here to talk about how to trade range-bound markets. But before I do, I just wanted to say many thanks, to those of you who joined us at the London Trader Show this last Saturday gone by. I hope that you had an enjoyable day. It was great to see so many people here, to be able to put names to faces. Thank you for attending the presentations that myself and my colleagues did there on Saturday. As I said, it was great to be able to meet some of you, great to be able to chat to you, and I think on behalf of myself, Vikesh, Ihan, and the whole team at ActivTrades, thank you for making it an enjoyable day for those of you who attended. If you've missed that and are hoping for future ones, then just keep an eye out for the IX Investors Show in London, where ActivTrades will be supporting that there next month. Keep an eye out for the data for you to be able to join us. And as I said, I hope to see and get to engage with a few more of you at that event next month. But in the meantime, here we have the Money Market Matters webinars. Today, we are going to talk about how to trade range-bound markets, and maybe a little bit different from some of the aspects we've touched upon in the past, but you'll see there's a reason for that as we go deeper into our session. So what should we talk about today on Money Market Matters? Well, we'll talk about the news. Remember, we always have a little bit on the news about what's coming up this week, so we're informed of what to look forward to. But we're going to talk about range-bound markets. So firstly, how do we define range-bound markets? What is it that basically we are looking for? And what do traders need to be aware of when taking that into consideration? And then we'll look about, actually, how could you utilize price action triggers or simple patterns in range-bound markets to help you with your trading? And then if we have time, as always, we'll check on the live markets as we go into the opening of the US session in about 26 minutes. So as always, lots for us to cover, lots for us to discuss, to sort of cram into our hour together here Monday afternoon. For those who don't know me, my name's Paul, traded for many years, traded for funds, traded for clients. Primarily, I like to focus on trading FX indices and some commodities. I tend to be a trend trader for longer term trading, and I tend to be a reversal trader for intraday trading. Both of those elements will play into what we'll discuss today, because I'll be able to sort of share some of my experience and some of my insight from over the years as we look at range-bound markets. So for those of you joining us for our first session, it's your first time at the Monday Market Matters. Well, what it is that this is ActivTrades start of the week webinar, right? Where basically we aim to help traders start the week in the right frame of mind as we get ready for the opening of those US markets. So every Monday, 2 p.m. London time, we look to cover things like the news, what's the major news to be aware of for the week ahead? The main element we'll focus on is an education piece, something to just help build and develop your own trading knowledge. And we'll look at some of the tools, that are available to you as an ActivTrades client. And as always, we'll finish with a look at the live market at the start of the US session, so we can get ready to see, how these markets are starting to prepare for the week ahead. So there is always plenty to be covered. We're always trying to cram in as much as we can into our time together. So let's crack on and have a little chat about news. I make no apology that for every week I start with the comments about the news section, namely, if you're a new trader just starting your trading journey, I don't expect you to be able to, necessarily analyze and understand every piece of economic data. But it is important that you know when that data is coming out, because that can induce volatility into the market, and volatility is very much a double-edged sword, right? If when you're on the right side of it, it's enormously helpful. When you're on the wrong side of it, that could actually be quite challenging. So it's in your best interests to be able to make friends with an economic calendar that will give you an insight into the news that's coming out that week. You will find that there is an economic calendar on the ActivTrades website and elsewhere on the internet. So there's no real excuse not to know when the big news is coming out. And well, October has been a rather eventful and interesting month anyway. I would hope you'd agree in terms of the formal news we have dealt with in terms of the economic news on the calendar, but also some of the informal news that we've had to deal with regards to, let's say, geopolitical events throughout the world. But what we're focusing on in looking at for the week ahead, well, looking at where is the interesting data that we need to sort of just make a note of, so that we can plan accordingly with our trading schedule. So this week there is quite a bit of PMIs. Okay, PMI data is coming out. PMI data is a useful element of data looking at the manufacturing and the servicing sectors of economy, because certainly for private retail traders, it can give you a very, very quick snapshot of the strength or weaknesses of those particular economies, because it's all really traded against the number 50. So any number above 50 shows you either the economy or whether the manufacturing and the services element are in growth. Any number beneath 50, it demonstrates an economy in contraction. So it is as a snapshot a useful tool for private traders just to get a very quick overview of the sense of that overall economy, because that will have an impact on things like the currencies, etc., of that particular, whether it be a country, whether it be a block. So it's a very helpful tool to give you a quick overview. There are certainly lots more of the data elements you can go into if you really want to go into depth, but as a quick snapshot, it's a really good starting point. So there'll be a lot of that data coming out this week. Okay, so you can see there for Tuesday, you've got the PMI data is out for Japan, France, Germany, EU, the UK, and the US. So worth taking a look at that. Wednesday, we've got the CPI data from Australia and the business climate indicator for Germany. We also have BOC meeting on their monetary policy and US new home sales report, and I think that might be quite interesting data for people to look at to see whether the interest rate rises that we have had over the last, let's say, 18 months, what, if any, impact they are having in terms of the impact on sort of property sales. Thursday is the ECB meeting on monetary policy, along with US GDP and pending home sales. And then Friday, there is some French data, but there's also the US PCE data. And this is an indicator, okay, it's focused on, let's say, unlike CPI, this focuses more on sort of, let's say, consumer expenditure, and it's the one that Mr. Powell and the Fed Reserve take a very keen interest in, as that helps give them an insight into how they should be looking to the sort of direction or the trajectory of their interest rate moves. So not unsurprisingly, that will also be interesting to many traders there. So as I said, as we run towards the end of the month, we've got quite a bit of data there coming out this week that will be of interest to traders. And then also remember, this is just the formal economic data. We will also have elements going on, for example, geopolitical events in the Middle East that may also have an impact upon markets based upon any sort of future developments we see occurring. So plenty to going on. Hence why it's important to sort of just keep on top of that economic calendar. So now we've looked at news, let's have a little look at education element, okay? What are we going to focus on? And as I said, we're going to focus on trading range-bound markets. And it would be interesting to know, of those of you here joining us here for the live session today, how many of you at the moment would look to trade range-bound markets? How many of you would have it as part of your own trading plan? It'd be kind of interesting to know what if any sort of impact or sort of thrust that is as part of your own trading plan, because as you can see on the slide, most of our trading education is centered around trading trending markets, okay, and for good reason. For new traders to be able, what we want to do is be able to sort of understand market dynamics, find a trend, and be able to find a way to engage with that trend and run with that trend. However, as it says there, and you hear me often say, markets only really trend for 20 to 30% of the time. The rest of that time, markets will either be in a range bound or in a period of transitioning. And my view is that longer term, okay, and longer term charts, range bound markets do provide opportunity for traders. So if markets are, if markets are only trending 20-30% of the time, and the vast majority of the rest of the time they're either range bound or transitioning, well, that might be worth having a little look at it in terms of opportunity, for traders. So today, what we'll do is we'll have a little discuss way that traders can take advantage of these situations. It might be another way for you to engage with markets, another way for you to sort of view and see and identify opportunity for yourselves. So let's start, as always, let's start at the beginning, ladies and gentlemen. So when I look at, let's say, the big picture, my view would be that we generally tend to see 5 phases of the markets. All right, 5 phases of markets. Let's get the old drawing tool up here. 5 phases of markets. First 3 are probably the easiest and clearest ones in many ways. Namely, that we have, one of the phases is a downtrend, one of the phases is an uptrend, and one of the others is a range-bound sideways market. And in many ways, they are probably the easiest to identify for new traders, and that's why a lot of traders will sort of spend their time focusing upon them. You hear me say every week, okay, when it comes to trending markets, okay, and trading trending markets, that a good trend will leap off the chart at you. All right, you do not need to force it. If you're forcing it, it probably isn't there. Okay, just take a step back, okay, and just have a little look and see what the market is trying to communicate to you. As I said, good trends leap off the chart at you. The challenge you have is that they only trend 20-30% of the time, and that is one of the challenges traders have. A lot of the time, the rest of the time, the market is sideways, and that's what we're going to focus on today, because that does provide opportunity if you're able to do the correct analysis and identify possible setups on there. The other 2 phases are how I would define as markets transitioning. Okay, so as in this particular case, it is where a market is transitioning from a downtrend to an uptrend, and hopefully what you can see there is the price was in a quite a clear downtrend, a little bit of a wedge, even you might say, before price got a little bit messy. All right, as it basically transitioned from that downtrend into that uptrend. And on the flip side, market might be transitioning from an uptrend to a downtrend. And we can see here, market had been in a nice uptrend, but then basically what we started to see was a bit of a turnaround there. It started to transition its way as it went from an uptrend to a downtrend. And the reason I put these in is because generally what we tend to find is that when a market is in a transition phase, very often it can be very unclear, it can be very scruffy, it could be volatile. Sometimes for new traders, it is quite difficult to analyze, identify, and make sure to sort of understand what phase that trend is, that particular instrument is in. My suggestion for new traders is that, really what you want to do is look at being able to focus your analysis in terms of being able to identify when a market is in a possible transition, so that you are in a position to position yourself accordingly. For some experienced traders, transitions offer great opportunities to join a new trend. If you're a new trader, my suggestion is that you just tend to focus, okay, on those first 3 phases, trying to find markets that are providing you either an uptrend, a downtrend, or a very clear sideways range-bound market. And that's that element that we're going to focus on today, because as I said, the transitioning markets, they can be a little bit difficult, a little challenging sometimes for new traders, because you're developing those skill sets, all right, to be able to analyze. And as I said, if you're unsure, okay, if you're not feeling very confident, there's a good chance that that market might be in a transition, and what you might want to do is just take a step back and just focus on the instruments that are in very clear uptrends, downtrends, or very nice clear range bound markets. As I said, be interesting to know, those of you joining us here today, what do you like to focus on trading yourself? Do you like to prefer trending markets? Do you like range bound markets? Okay, what do you have a natural preference towards? Do you even know? Okay, it's very possible that you're at the start of your trading journey and you're still learning to work out what works for you. What I can guarantee is that time and energy spent on identifying the most favorable market conditions for your trading style is time well spent. Okay, time well spent. So Cynthia says I prefer trending markets. I cannot stand range bound markets. Fabulous, Cynthia. Okay, appreciate the feedback. And a good part of it is about recognizing which market environment is the most suitable for you. Some people love trading trending markets. Some people love trading range bound markets. Some people actually love trading transition markets because they like the kind of the volatility, the broken down in the markets. All right, and they like to challenge off that. And I'm very much a case of each to their own. But it is really imperative to know which ones tend to suit you. And the way you do that is by doing your analysis, taking your trades, keeping good records, starting to identify the sort of almost like the trends in your own trading. Being able to do that is one of the things that will help you accelerate as a trader. So that's all well and good, but let's start to look about, right, okay, if we're going to do some range bound trading, how do we do it? What do we need to be aware of? What do I need to sort of just make sure is in my checklist? So, not unsurprisingly, in terms of first points, clearly identify that this market is range bound. All right, yeah, that is quite self-explanatory. But how do you actually do that? So, my suggestion is, as I said, the longer term range bound markets, they provide opportunities to trade those particular swings. So my suggestion is always is that, if you focus on the weekly and the daily charts, that gives you a great opportunity to identify possible range bound markets. So you'll have heard me always talk about whenever you open a chart, okay, of any instrument, whether it be gold, whether it be Bitcoin, whether it be euro dollar, doesn't matter. Okay, one of your first tasks should be to ensure that you're drawing in horizontal levels of support and resistance. Start at the monthly chart, go down to the weekly chart, then down to the daily chart. Draw those levels in because they will start to help draw your eyes towards visual representations of markets that might well be in a range bound area. What can also help, in identifying range bound markets is big round numbers. Are there certain particular numbers, that the market seems to respect and either treats them as resistance or treats them as support? So, for example, just off the top of my head, if you were to look at, let's say, gold charts over, on both the weekly and the monthly chart over the last few years, you would find that, the big round number of $2,000 has acted as really good, strong resistance. Whenever prices come up to that area, it's been rejected away. You might actually even look at the Russell, the Russell 2000 US index. Once again, looking at the 2000 level on there, the big round number. If you look at that over the last year, you will find that basically whenever price gets there, it gets rejected from them. We'll have a little look at the live charts on that in a few moments' time, so be sure to stay with us till the end. The whole idea is that we are starting to sort of draw in that and get an idea of levels of support and resistance and also big round numbers. What can also help you is that, how are the moving averages working? How are they actually looking? So I wouldn't particularly, I wouldn't basically base everything just in terms of identifying ranges on moving averages. Moving averages are exceptionally good for identifying strong trends and strong areas of dynamic support and resistance. That's my belief in how I'd work with them. However, one of the things that is very useful is using something like the weekly 50 period moving average. In this calendar, this is FTSE. This is the FTSE chart, and you can look at that on things like the weekly. Once we're seeing the red 50 period moving average starting to go flat and go sideways, that in itself I find is great confirmation that we are getting into a particular range bound market where there's a levels here. So in that particular case, I think it's about 7,700. We can see that basically once it had been support, became resistance, didn't it? Okay, then it basically tried to be resistance, and we're going to come back to a double top there, and then invariably another double top there. Okay, and so suddenly we find ourselves in a range. Now, if that was a 5-minute chart, I'm not saying you couldn't trade that, but things would change very quickly. Whereas when you're trading it as, let's say, on the daily chart or the weekly chart, and you're able to identify the edges of those range, okay, the side edges of those ranges, well, what we're able to do is to start to put together a little bit of a trading plan, which we'll look at in a moment, where we're focusing on confluence of events. Okay, you hear me talk about this all the time. I'm always looking for a confluence event. So a particular level or area where there's 2, 3, 4 things coming together in one time and place. That is what gives me idea for a possible trade setup, and we're going to discuss that more in detail in the next few slides. One of the other points we look at in terms of range bound trading is, and this is my personal trading style. This is my personal trading view, is that ideally, okay, we're looking to trade at the edges of the range. All right. Look at this very clearly. I am not interested in trading in the middle of the range. Others may wish to, and that's their choice. Okay. Everybody's allowed to trade in the way that suits them best. But for me, when I see ranges, all I'm interested in is looking at how does price respond at the edges of the range. Okay, so I think this is it might be a daily or weekly chart of the DAX. I think it's actually daily chart of the DAX. But hopefully, what you can see is that there's kind of a significant kind of levels of support there. I think it's about sort of just about 15,800. We had the higher levels of resistance. Okay, but we also had ranges there. As I said, I am not particularly interested in trading in the middle of ranges. Okay, when I sort of start to identify this, I am not interested in that. I am interested when price gets to the edges of these ranges, and how does price actually respond? How does price respond at the edges of the range? That is where I start to become interested. That is where I think there is opportunity, because if you're trading, on the longer time frames, weekly, daily, and maybe to a lesser extent the 4-hour charts, there are swings. Okay, there are swings that can be picked up. Okay, that actually offer you the opportunity for asymmetric reward to risk, trade opportunities, and that's what I'm always interested. How does price react at the range's edges? That's what I'm interested in, and if I go deeper, I'm looking to identify possible reversal patterns along with some price action candlestick triggers. So let's have a chat about them. Let's have a chat about reversal patterns and price action candlesticks before we go into looking at, well, how do we look at them when we're viewing the kind of edges of range bound markets. So for those of you who are new to trading, those of you who may not have, learned or understood, reversal patterns, this is just a quick screenshot of reversal patterns. What I'd suggest, if you haven't already, just take a screenshot of this as you see this on your particular chart, and you can go away and start to learn them. For those of you who were at the panel that I took part at the London Trader show on Saturday, we're talking about particular, technical analysis patterns. I myself talked about how I do like a good head and shoulders pattern. I also like key reversals. I also like double tops and double bottoms. I like triple tops and triple bottoms, but I don't see as many of them as lots of other people's sort of tend to. And whilst very possible, you can use things like cup and handles, V spikes, saucer tops, megaphones. Whilst they are valid, I personally, I know what I particularly prefer to see, which is things like, as I said, head and shoulders and inverse head and shoulders, key reversals, double tops and double bottoms, and some triple tops. And that's what we'll focus on today. We'll just have a quick look at some of those, just to give us a little bit of a reminder, okay, of these patterns. And if you're a new trader, just give you a little bit of insight into how they play out in markets, so we can start to, when we identify them at the edges of ranges, well, that might start to give us the confluence of events of what we're looking for, of 2, 3 things happen at the same time and place, to give us a trade setup opportunity. So head and shoulders pattern, all right, and not unsurprising, an inverse head and shoulders pattern is the opposite. If you are very, very new to trading, okay, you will be able to see that, it looks like a head and shoulder, and you have the head above the left shoulder and the right shoulder. Classically, the right shoulder should be lower than the left shoulder, but it doesn't have to be. And if you look at classical technical analysis, what we'll be looking is that once you identify the neckline here, as you can see there, once you take the measurement from the head, okay, the top of the head down to the neckline, and then once price breaks out, that is where you would project that forward, and that becomes your target. So once you identify a head and shoulders pattern, you're also looking to identify that kind of the distance between the head and the neckline, and then project it forward from the pullback. And that is the, let's call that as like the classical view of trading a head and shoulders pattern. Now, I have a few little bit more advanced entries, but that's just out of experience. But if you're a new trader, that's what we're looking at today, and I find these very useful. If you want to look at them in a bit more detail, if we look at you could look at things like Nvidia on the weekly chart. That has been creating a head and shoulders pattern quite nicely there on the weekly chart, as I said. This is one from a little bit of a while back. This is on the sort of the DAX and the weekly chart. But the reason I wanted to be able to see it is that even though price here had put in a really very large double bottom, we then went range bound for a couple of months before we went up into a very nice trend. And the reason I want to take is that actually for what was effectively here, about 15 or 16 months, that is how long it took for this head and shoulders pattern to develop on the DAX at that time. So when I talk about trading weekly charts, daily charts, it allows you the time to basically do your analysis and identify these possible setups occurring. Okay, and with that, you start to be able to see, well, that in itself, okay. That in itself for the more advanced traders, that in itself, the swings between there on the weekly chart that created the head and shoulders, they in themselves presented themselves as opportunities, okay, as swing trading opportunities as part of the bigger position. And we might look at that a little bit more depth when we switch across to the live charts. But that's an indication of one version of a head and shoulders pattern. It certainly doesn't need to be as big as that, but what I'm saying is if you are looking at charts, sometimes it might take that longer, okay, and that can be very helpful. Inverse head and shoulders, okay, is not, as the name implies, is the opposite. And what we see is basically, we see an inverse head and shoulders. And once again, remember, once we're seeing this identified, we're looking to identify the neckline. And then classical technical analysis would identify the range and distance between the head and the neckline, and then project that forward once price breaks that neckline, because that would then become your target there. Okay, and that's the classical interpretation of a head and shoulders pattern. And this is, once again, this is, kind of trying to show over the longer term frame. This was in the FTSE, and hopefully you might be able to see is that a price had been in a downtrend. At that time, it created, okay, a bottom, but actually it was only when we started to create this lower head, okay, formation that people would start to be interested. We came back down, and then this kind of maneuver here became the right shoulder. And actually, what this was actually from a few years ago, because this was effectively that move there was effectively the sort of the run into the Brexit vote. And for those of us who are watching it trading, you can see that it was actually setting up an inverse head and shoulders on the FTSE. And once we saw was identifying the neckline, once the price broke, you can see for yourself that basically that worked out very, very well for the FTSE itself. So head and shoulders patterns are nice, and I would like them and see them, but more frequently what we're looking at is double tops and bottoms. And I particularly like trading personally myself double tops and bottoms across all time frames, from intraday up to the higher time frames. All right, and because I find them very easy to see, I find them easy to identify, and I have my own variations on how to trade them. But as the name implies, a double top, okay, for the new traders is almost like, if it's just like a capital M, all right, that is being formed, all right. And once again, traders are looking to identify that neckline. In an ideal world, okay, what you'll see me, I will sometimes call it a 1, 2, 3 top, because I want the second peak to be lower than the first peak, because that gives me an indication that basically the price doesn't have the energy to form a new high. If we're following Dow theory, it should form a new high if it is in a uptrend. The fact that it can't, that in itself gives me an indication that price is probably more likely to roll over and fall away. And that's where I want to be able to position myself. That's what the market is explaining to me. S&P 500, okay, from a while back, it had been in a trend, but then actually what started to happen is that we started to go sideways, and then we had a final push out, which became that double top there, okay, the double top before price fell all the way back down to the kind of the lows of a few months earlier. So as I said, it's a double M pattern, okay, and ideally the sort of the second peak should be lower than the first. That doesn't always happen, but in a classical sense, that is what you're particularly looking for a classical double top. Not unsurprisingly, double bottom is the exact opposite. It's like a big capital W, okay, that's being drawn there. And we have our peaks, okay, and I would normally sort of label it 1, 2, 3, because the 2 is the neckline. And classical trading of a double bottom is that when price breaks that neckline, okay, 0.2, that is when most traders would be looking to sort of, to go long with their stop loss beneath the low of 0.3 or 0.1, depending upon their risk type. And that's what you'd be looking at. Now, remember, what could occur is that the neckline might in itself be the level of support in a range-bound market. It could be that price might sort of come down, okay, and find itself there before we move back up. So that is always worth just bearing in mind when and if you see this on the longer time frames. And hopefully I've got 1 or 2 examples of that from live charts that we can have a look at as we go through. Yep. So this is an example on oil. You can see that basically price had been in a downtrend, but basically we put in a very nice double bottom. We can see where the neckline was, and then price started to move. Comes back to retest the neckline, which is not a few thing, but then over that period we can see that price doubles. If we look at things like the pound against the New Zealand dollar, which we'll look at in a live moment, the moment that is on the daily chart, that is printing pretty much the same. Okay, that sort of double bottom there that we see. So it's well worth taking well worth being able to identify. And as I said, when you're looking at these on the weekly and the daily charts, when you're seeing these patterns, well, they take time to develop, right? Which means if you're a new trader, you get the opportunity to spend a little bit of time making sure that you're doing your correct analysis, being able to identify for it without it requiring you to be sort of sat there at your screen for all of the hours of every day. If you want to go one step further, well, then you've got triple tops and bottoms, all right? And as the name implies, okay, you've got basically 3 tops that should create a neckline. And when it finally breaks that neckline, price would move its way down. And on the flip side, a triple bottom, there's 3 bottoms, which creates a neckline. And most traders will be looking to sort of take the trade when it breaks through with a stop beneath the recent low on a double bottom. Or if you're shorting here at the neckline, your stop would be above the recent high on a triple top. We saw actually a very nice, if I remember right, very nice triple bottom on gold. Okay, a few months back, okay, maybe a year back, as we saw it move, and we'll look at a live example of that in a moment, give you an idea of how to identify these particular patterns. So those are reversal patterns, and those are very good solid reversal patterns, which I am very happy to use in my own trading when I see them occurring at the levels, okay, at the edges of range-bound markets. I do know that some people like to trade things like double tops and bottoms within a range, but as I said earlier, my personal style, okay, yours is very welcome to differ. My personal trading style is that I am looking at the edges, okay, the edges of range-bound markets. What is going on there that might give me an opportunity? And if it's not printing let's say a huge reversal pattern, what it may do is may actually provide us just a simple trigger using a price action candlestick that might be a single candlestick, a double candlestick, triple candlestick, maybe even a little bit more of a combination. But these are very simple price action candlestick triggers that we can utilize as I said, as a trigger into the market. Very often what I find is that people forget that candlesticks by themselves are in fact a reversal pattern. And by doing so, you have to have something to reverse. So I'm looking for price to swing its way up to either resistance, okay, in the range bound market, or down to support, and then print a good candlestick pattern. And it might be something like a rejection candle or a pin bar. You may know of it as a hammer or a shooting star. Things like an engulfing candle, all right? So, these are hammers and shooting stars, engulfing candles, okay, where the candle entirely engulfs the candle preceding it, okay, in terms of a bearish engulfing candle or a bullish engulfing candle. Key reversal candles, okay, where, price may be moving up, but in a bearish key reversal candle, price pushes to new high before it rolls over and closes beneath the low of the previous candle. Or in a bullish candle, price is moving down before it pushes to a new low, before it rallies, okay, and closes above the high of the previous candle. That'll be key reversals or morning and evening star formation. So for a morning star formation, we get a bearish candle followed by what might be a reversal candle or an indecision candle. Could be like a doji, could be a hammer or shooting star, followed by a very strong bullish candle. It's a morning star because it's like the morning rise, okay, sun rising, or an evening star where we get very strong bullish candle followed by something might be like a hanging man, okay, or a shooting star or an indecision candle followed by a really strong bearish candle. And that's an evening star because it's like as the sun sets, okay, that's what we're expecting. We're expecting price to fall as well. So these are all very, very valid, good candlestick reversal patterns. And so when we see them at the edges of range bound markets, they in themselves might provide a good insight and a good trading setup. So the important thing is, as always, you'll hear me talk about is that, regardless of what we're sharing here, it doesn't escape good trade selection. That's paramount, okay? And I talked a little bit about it on Saturday and on the panel for the London Traders Show. Is that it is not enough just to understand the pattern. That what we're looking for is the context, okay? You want to understand the context. Now, in this particular case, we are looking for the context to be that price is at the edge of a range-bound market. So we might have a horizontal level of support resistance. We might have, a big round number. We might have bounced off that level before, and now we find ourselves back at that level. And what we're seeing is either a price action reversal pattern, things like head and shoulders, double tops, triple tops, etc., or maybe just a simple candlestick, okay, like pin bars, engulfing candles, star formations, key reversals. It is all about the confluence of events, 2, 3, 4 things coming together at one time and place. That is what gives me a higher probability that price is more likely to move in a particular direction over the next few sessions. And that is why identifying these things is what can actually help you improve your R3, all right? R3 just simply being a quick word or a TLA for your risk to reward ratio. And that's what we're looking to do. You will hear me talk about, I'm always looking for asymmetric reward to risk ratios. That's what we're interested in. That's what we're focused on, okay? Risk to reward ratios. We want to give ourselves the best opportunity to be able to achieve things like that. If we want to sort of make it a little even clearer, as I said, a confluence of events, we want to see these reversal candle patterns, okay, bang, hammers, all right, pin bars, engulfing candles, key reversals, star formations, at a level of support resistance after a move towards the edge of that range, where we have 2 or 3, 4 elements coming together one time and place. That is when we generally have more success. And why we also see and why there is an element of subjectivity in such trading methods, because even though we might say, well, do you know what, Paul, I love to trade at the edges of range bound markets. That is my context. That is my environment. That's what I like to trade. Well, one trade might be, a pin bar off that level of resistance. The next time it might be a key reversal. The next time it might be a double top. Next time it might actually be a sort of a head and shoulders pattern. It could be, these are the sort of, the pattern, in line with the overall context. Okay, context, pattern, trigger. That's what you'll hear me talk about an awful lot. CPT, the context, the pattern, and the trigger itself. So just to kind of quickly remind some of those people, and just a couple of quick slides to remind people. If you want to go into more depth on those reversal patterns, then please by all means, look at the ActivTrades website. Be sure to look at if you go into the education element, if you look at the archive in there, you'll find there are lots of, there's, lots of fabulous previous webinars by myself and my colleagues here. Some of them will specifically be sessions on these individual price action setups, okay, these price action candlesticks, pin bars, okay. Now, pin bars, you will find they are a very powerful candlestick signal, and they're quite visual, and they are quite ubiquitous, and they are deemed rejections when a candle forms the wick, okay. This is the wick here. Those wicks, okay, are formed by an extreme shift in trader bias and sentiment, and that's what I'm looking to try and utilize. We attribute that wick with volatility and a higher probability move in the opposite direction, okay? So in terms of a pin bar, I want to see things like a bullish pin bar at the end of a downtrend where price basically opens here, price pushes down, then the buyers step in and they push price higher, past the open, and closes up on its highs, because I know, okay, there's been a shift in trader bias, and the higher probability move is to the upside over the next few sessions, and I want to make use of that. In the same way that on after an uptrend, okay, if I've hit a particular range of resistance, the resistance at the top levels of a range bound market, what I'd like to see is things like a pin bar, okay, a bearish pin bar where we see price open, price pushed up, but the bears have stepped in and they've sold us all the way down, okay, we've closed beneath the low, because I know the higher probability is that price will likely to move down in that, and that's where how I want to position myself accordingly. So what you will find very often with pin bars is that you'll hear people call them pin bars, high tests or low tests, rejection candles, hammer or shooting star. I don't actually mind how you label it, okay? How you label it, fill your boots, whatever pleases you. The important thing is that you can identify and understand what one is and why it is useful to you. So good pin bars, all right, you should have the open and the close within the range of the previous bar. The candle wick should be 2 to 3 times the length of the body, should have a long nose protruding from all the other bars, and the good pin bars stick out, and they are very, very obvious. And as I said, if you want to go into that in more detail, there are sessions in the archive specifically dealing with them, okay? They give a good indication of supply and demand. They're clear and easy to see in the charts, all right? So if you focus on trading pin bars in range-bound markets, you want to see these print at the edges, and we'll look at that in a particular moment. So, in a particular example, okay, that let me just get the old drawing tool up here. So this is the pound against the Swiss franc here on the weekly chart, and for pretty much for the vast majority of the last year, what we had was price basically was in a range pretty much between 111, okay, 111 and 115, okay. This is on the weekly chart, and that's what we saw. And actually, price swung its way between those particular levels, okay, between those particular levels, all right. And what we've seen there is, that actually that range tightened up over the last couple of months, and then in the last couple of weeks, what we saw was it actually break out. And that is the thing with the range bound market, is that ultimately at some point it will break out. That's just the way the nature of the market goes. Markets go, from compression to expansion, back to compression. We had compression here, and then we've had an expansion there, okay. But just looking at the weekly chart there, okay, there's price action, just let me clear, price action setups, reversal patterns, okay, that happened here. This candle here was a very strong bullish key reversal candle, okay. This strength here was a bullish key reversal candle, which was also part of a morning star formation, and price actually rallied its way back up to this 115 level. And then we saw as price came down, what you can see is that price bounced off this 111. It was a range, okay. That range went from being 111 to 115 down to, again, basically 112, okay, 111 to sort of 112.50. Remember what I was saying earlier is that, one of the things you can look at is, how are the moving averages acting? As the red 50 period moving average started to go sideways, didn't it? And it became the resistance. So that range that we'd had for about a year tightened up even further, okay, before it expanded out, okay. And so this is why looking on the weekly and the daily charts gives you time and energy to be able to identify these levels, identify these ranges, and be ready to position yourself accordingly. And if you look at the daily chart from coming into the summer itself, okay, let's just, if we go down here, this was going down into the daily chart, and what you can see here is that, once again, we had 115, 111. If you look at the daily chart, we had a bit of a rejection here. There wasn't really any price action there, but when we came back down to this 111 area and we rejected there, it's not a very pretty morning star there, but what we can see is it rejected it. But here we had a double top, okay, but basically we had a double top. Some people might even say it's a triple top, but personally I would have looked at that as a double top, okay, and I like the fact the second leg was also a rejection candle there. Before, what happened is, okay, price worked its way all the way back down to this 111 area, didn't it? What did it print there? What's that? Well, that is a bullish engulfing candle. It's a bullish key reversal candle at that level, which then actually became the first leg of a double bottom there. All right, a double bottom, and price then rallied its way up there. It didn't actually make it all the way up to 115, but there was enough of a swing there, okay, enough of a swing in order to make that a useful trade setup, okay, from the double bottom or from the key reversal. The price came back down to the 111 area, and what did it print here? Not a terribly pretty double bottom, but there was a rejection. We came back down to that level. What did we print here? We printed, a pin bar, okay, a pin bar before price rallied its way up here. Here we were in the middle of the range. Remember, I was saying I don't really particularly like trading in the middle of the ranges. Okay, that's not really for me. But once price came back down to the area, okay, what we had was, we had basically a. Let me just clear some of these drawings off here, make it a little bit clearer for you to be able to see. What we had here was an inverse head and shoulders, didn't we, ladies and gentlemen, with the neckline, and then we saw price break it. It went sideways, okay, the 50-period moving average was going sideways, but it was forming, okay, it was forming higher lows before price rallied its way up. And where did it rally its way up? Where did it run out of steam? Well, it was at steam at the 115 area, and on that day it printed a bearish engulfing candle, which was also a bearish key reversal candle because price had pushed to a new high, apart from its other candles, then rolled over and closed beneath the low of the previous candle. And then what we saw is price drifted its way down there. So here, you can see how on the weekly chart, you can start to identify levels. And when you go down to the daily chart, well, you can start to see those confluence of events. When you're at the edges of those ranges, that is when I'm interested. At those edges of those ranges, I'm looking for confluence of events. I'm looking for things like double tops, double bottoms, head and shoulders, inverse head and shoulders, looking for bullish engulfing candles, bearish engulfing candles, pin bars, star formations, key reversals. They are there. You just need to basically take a little bit of time in terms of having a good process for your analysis to be able to understand, okay, and see, when price gets back to these levels, well, if it gives me the kind of rejection or reversal patterns that I'm looking for, that is what's starting to provide me with a trading opportunity. So, example on FTSE, okay, for last year, actually, this is what we saw, for most of last year, okay, if you look at that, FTSE on the weekly chart was pretty much in a range between big round number of 7,000 and around about 7,650. But you can see 7,000 had acted as strong support and resistance, okay, the year before. But for this year, what we can see is we just basically, hopefully you can see, we just literally bounced our way between these kind of areas here for pretty much most of that year. And then at the end of the year, start of this year, we broke out. But we had a whole year there of bouncing between those levels. And my belief is, as a swing trader, there are opportunities there in that range bound, okay, in those range bound markets, okay, and by understanding the price action that we've talked about, okay, so far today, that is what helps make these elements, these environments, a viable opportunity for us. Because when we go down to the daily chart, okay, let's just get the pen up here. Okay, what we saw is the first time it bounced, that was effectively a little bit of a hammer there. Okay, a little bit of a hammer there. You might also say, some people might say it was a bit of a double bottom there, not an unconventional one. But once we got to the top, back up to this area. We printed an engulfing candle. Price moved down into the middle of the range. Remember, I'm not really interested in trading the middle of the range, but when price came back up, well, actually what we started to do is put in head and shoulders patterns there. Head and shoulders pattern before we dropped. Where did we drop to? Big round number 7,000. They're not a terribly pretty, morning star there. Okay, lots of people would have just maybe struggled with that. But once price had taken away from there, where did it go? It went back up to those recent highs, and that recent high was ended by that double top. Okay, the price started to come down, moved into the middle of the range. The trade into the middle of the range. I don't really like to trade out of the middle of the ranges, but once price came back up, well, actually what it did is it put in a very tight sort of triple top before it dropped. Where did it drop to? It dropped to that big round number of 7,000 again. They're basically putting a double bottom there, takes away, which actually then becomes a triple bottom, becomes a quadruple bottom, right, before price rallies its way back up into this range here that we've seen before, rolls its way over, comes back down, and then actually what we see is we actually start to see a breakout of the 7,000 there. There's a big number, there's a big W there, but that's what we're looking at. And so literally over the whole of that period, you can see that price, there's lots of trading going on, but it's at the edges. It's at the edges of the ranges that I'm interested in, and that's my suggestion in terms of if you're going to look to trade range-bound markets, that's how we look to achieve it. So remember, ladies and gentlemen, there is no such thing as perfection in trading. Okay, there never is. All right, at some time, price will break out of a range-bound market and start a new trend. That happens to everyone. Okay, welcome to trading, but it also means when it does break out, you've actually just paid for information telling you that a new trend is starting, and it might be time to switch from your range-bound trading tactics to your trend trading tactics. So just bear that in mind. Okay, so thanks for joining us today. We're just going to switch to the live charts in a moment, but before we do, just thanks for joining us. Okay. We said at the start that this was going to be an interesting year in markets, and it most certainly has been. And thanks for joining us. We look forward to you joining us for future sessions. As it says there, most of the time we focus on teaching new traders about trending markets. And that's absolutely all well and good, but markets only trend 20 to 30% of the time. And some markets may remain in strong ranges for months, even years. And that can provide us with an opportunity, especially when we look at things like price action reversal patterns, like head and shoulders, triple tops, all right? And also price action candlestick triggers, things like pin bars, engulfing candles, key reversal candles. They can actually help us generate an opportunity as part of a confluence of events, indicating a move back into the range and also perhaps to the other side of the range itself. So let's have a little quick checkout on live markets. Before we do, just remember next week, 30th of October, next Monday session, we're going to look at trading gold, okay, which is pretty relevant based upon some of the interesting moves we've seen there over the last few weeks. So 2 o'clock London time next Monday. If you're not registered, make sure you are. You can look at the QR code there, take a screenshot of that on your phone. It'll take you to the website to be able to register for that, and I hope you'll join me. So as always, I appreciate we probably went over a little bit there. So, but I hope you found that useful. If you've got questions or comments, you be sure to email englishdesk@activetrades.com. And if you just bear with us in a moment, what we'll do is we'll switch across to the live chart. So just bear with us one moment. The ActivTrades platform. This is one on US indices. This might help us with. If we look at here we go. Super. So this is a chart of the Russell 2000, okay, one of the, let's say the 4 major US indices, one of the that you can trade through ActivTrades. What I have here, I'm hoping you can see, is that this is the weekly chart, okay, of the Russell there. I'm just going to move this here. I'll just, hopefully you can even just quickly, you can see that, for the most part, over the last 18 months, we have been pretty much in a range there. Would you agree with me there? Namely, we've had down here at the peaks, look at that, at 2000, and I would say 1700. I'm just going to draw a level in there. Just bear with me 1 second, and we'll just draw in another level there just to help us get a little bit clearer in our view. Boom. Okay. I'm going to make this 1700. Let's just very quickly You'll do that there. Excellent. So I'm hoping you'll just basically give us that as well. There we go. So bear with me 1 second. We'll just put that all in the right place for us. There we go. So hopefully that kind of frames it even better for us, that you can see that is what has occurred then. Let's just the drawing tool here. What I'm hoping you see is that every time we got up to 2,000, price has basically bounced away from it, hasn't it? Price has bounced away from it. And in this particular one here, what we had was, a little bit of a megaphone, but actually also that is a bearish engulfing candle, and where every time it's rejected 2,000, where's it gone to? Well, it's gone down to the kind of 17,000. And, we've had kind of bullish pin bars there before we've moved up. Come back here. This was we look at a lower time frame, a double bottom before price worked its way up. We've come down here. That is a kind of a morning star formation. There we have a kind of a pin bar which became a double bottom before we rallied up there. And actually, what we're happening here is last week, we can see we've fallen down, but as markets have been working with the geopolitical elements, we've had our first close beneath 1700. Okay, last week we had our first close beneath 1700 for almost a year. Okay, almost a year. That is interesting. So I'll be looking to see, does it continue if the geopolitical insecurity continues, or will there be an opportunity for it to bounce and rally its way up there? But this is a good example of being able to just look at the weekly chart and just hopefully see where, identify those ranges, which are all around big round numbers, 1700 and in particular 2000, and look at that and see how that has performed as effectively as a range bound market. Let's just see if we, boom, yeah. If you go down onto the daily chart, you can see that has really been in that range, for about 18, 19 months. Okay, it's been there for a good while. There is always that, and being able to look at it on the daily chart gives you the opportunity to turn those bigger picture into, is there an idea of an ideal trade opportunity setup? All right, and that's what we are particularly looking for. And we'll have a quick look just before we run out of time on gold. And the reason we look at gold is here we go. Is that let's just zoom out a little bit here. So gold, okay. Now, once again, you might remember I said $2,000 in gold. What you can see is that every time prices got up there, okay, last year double topped with a pin bar. Even this year, we've kind of double topped there before we came down there. At the bottom, once again, 1700 here, okay. What did we have here? This was a triple bottom that also had a bullish engulfing, bullish key reversal candle. And here we had the double bottom there, okay. There we had a pin bar. And so hopefully you can see that these ranges, okay, between, even in gold, between 1700 and 2000 on the big picture, they have been quite some moves there, right? And and as I said, you've got the time to be able to watch these. And now we're looking to see, is price going to get back up to that 2000 level? And if it does, what happens? Does it get rejected? Okay, like it has done, or if we close through it and move on, well, that's an indication of a complete change in the market environment. So, we're at an interesting point, okay, where I'll be looking for a confluence of events to sort of give us some insight into what may occur. So, I think it might be an interesting couple of weeks, okay, interesting final few weeks of 2023 as we identify what the gold is going to do. So I apologize there, ladies and gentlemen. Time flies when you're having fun. We run out of time, but I'm hoping that has given you an idea how you could turn a range-bound market into an opportunity, and being able to even just look at the Russell chart and the gold chart to see how, doing your analysis on the big chart, big picture, identifying those levels starts to give you an idea of a way to identify good, big range-bound markets. And within those range-bound markets, there are opportunities for swing trades. So thank you all for joining us. I hope you found that useful. I hope that's found you found that helpful. Just have yourself a fabulous trading week. As I said, be sure to join us next week, where we're going to actually focus on trading gold specifically, and we'll talk about that, okay, and what is actually available for you. And until such time, trade well, everybody. Have a great trading week, and I will speak to you soon. Many thanks.